You work for 30 years. You make the sacrifices. You max out the 401k when everyone else is spending. You skip the vacations. You drive the car an extra 4 years past when it stopped feeling comfortable. And then one day, you look at your retirement account and the number says $1 million. That feeling is real. You earned it. So at a family dinner, maybe Thanksgiving, maybe just a regular Sunday, you say it out loud. Not bragging, just sharing. We finally hit the $1 million mark. Something like that. And something shifts. Not loudly. Nobody stands up and says anything. But you feel it in the way people hesitate before offering to split the check. In the way your son-in-law makes a comment about the housing market. In the way your daughter starts a sentence with, "I know you guys are in a good place now. You went from being mom or dad to being the family's financial backstop." Nobody decided that. Nobody announced it. It just happened the moment that number left your mouth. That is the paradox. The milestone you spent decades working toward can protect you, or it can become a burden, and the difference often comes down to one decision. Who knows? Today, I want to walk you through exactly why that $1 million creates a distorted picture in the minds of people who love you, and more importantly, I want to give you a specific communication framework. What I call the safe, not rich script, so you can protect what you built without coming across as someone who stopped caring about their family. If you are in your 50s or early 60s and you are thinking seriously about the final stretch of retirement planning, subscribe to Wes Investor. We cover asset protection strategies that most people do not hear about until it is too late. There is a moment at a family dinner that I have seen play out more times than I can count. The check arrives, and there is this pause, maybe 3 seconds, where everyone at the table quietly stops reaching for their wallet. Eyes drift, not directly at you, but in your direction. Nobody says anything. Nobody has to. The unspoken logic is already in the room. You are the millionaire, so naturally you pick it up. That is not greed. That is a math problem, specifically a gap between what you understand about that $1 million and what everyone else assumes. You see a machine, a carefully built structure that generates income so you do not run out of money before you run out of years. They see a pile of cash sitting in an account, waiting to be useful. And that gap is going to cost you if you do not close it. Here is the math they are missing. According to the Federal Reserve's Survey of Consumer Finances, the median net worth of American households between ages 65 and 74 is around $410,000. So when you walk into a room with $1 million, you look like you have 2.5 times what the average retired household has. From the outside, that looks like abundance. It looks like wiggle room. But what does $1 million actually produce? Under the 4% rule, which is the standard guideline most retirement planners use to ensure a portfolio lasts 30 years, your $1 million generates roughly $40,000 a year before taxes. That is about $3,300 a month. In most American cities, that is not wealthy. That is managed. That is careful. That is a budget you have to respect every single month, or the whole structure starts to crack. They do not see a $40,000 annual income. They see 7 figures, and they do math that goes, surely they can spare $10,000. And then come the asks. Not from bad people. From people who love you and who genuinely do not understand that what looks like a pool of money is actually a narrow stream you need to last 25 to 30 more years. A few thousand for a car repair. A loan to help with a down payment. A temporary $5,000 because things got tight this month. Each one feels small in isolation. Each one feels like something a reasonable, loving parent would just handle. But here is what each of those requests is actually doing to your retirement math. Every dollar you pull out early is a dollar that stops compounding. And in the early years of retirement, that matters more than most people realize. There is a concept called sequence of returns risk. It means that if you are withdrawing money during a market downturn, the damage is not just the loss itself, it is the permanent reduction in the base that recovers. If emotional withdrawals push your actual spending rate from 4% up to 6% or 7% in those first few years, you are not just spending more. You are quietly shortening the runway of your entire retirement. I have watched people start retirement feeling solid and find themselves anxious 5 years in, not because the market crashed, but because the small, guilt-driven withdrawals quietly added up to something their plan was never built to absorb. You cannot hand them a spreadsheet to explain this. You cannot sit down at Sunday dinner and walk your family through a 30-year Monte Carlo simulation. They will not retain it, and honestly, it will feel condescending to try. What you can do is change the language you use to describe what you have, because language shapes expectations. And right now, the word retirement savings is working against you. I used to believe that being fully transparent about money with family was the right move. That honesty would lead to understanding, that if people knew the real numbers, they would respect the boundaries naturally. I was wrong. Financial transparency without the right framing does not build trust. It builds expectations. And expectations that are never discussed become debts that are never repaid. So here is the reframe. Stop describing what you have as savings or assets. Start describing it as a paycheck system you cannot touch. When someone pictures your retirement account as savings, they picture a reservoir. Something that fills up and sits there. Something that can absorb a withdrawal without much consequence. But when they picture it as the mechanism that generates your monthly income, the mental model shifts. Nobody asks to borrow from your paycheck. Nobody expects you to reroute your salary to cover their shortfall. A paycheck is already spoken for. That is the psychological move. You are not hiding anything. You are just describing the same reality more accurately. Here is what that sounds like in practice. If someone asks why you are being careful with money, you do not say we have $1 million, but we need to be cautious. You say something like, our retirement account is basically our employer now. It pays us a fixed income every month, and that income has to cover everything: healthcare, housing, the basics for the next 25 to 30 years. There is no flexibility built in. If we pull from the principle, we are cutting our own salary. That is it. No apology, no over-explanation, no number that invites negotiation. The word shift matters more than people expect. Savings sounds optional. Fixed retirement income sounds like a constraint that exists whether you want it to or not. One of those framings makes you sound like you are choosing not to help. The other makes it clear that the system itself does not allow it. Your optionality, your ability to make real choices in the next 2 decades, depends on managing what other people expect from you now. That is not selfishness. That is the only way the machine keeps running. Let me give you 2 versions of the same retirement. Person A hits $1 million. Their adult child needs help with a down payment. It is $100,000, and it feels manageable because the account still shows $900,000 after. They feel good about it. Generous, like they did the right thing by their family. 3 years later, a health event happens. Not catastrophic, but serious. A surgery, a recovery period, some ongoing medication, maybe a specialist who does not take Medicare. Suddenly they are drawing down faster than planned, at a moment when the market is also pulling back. They are selling assets at a discount to cover bills they did not fully anticipate. The $900,000 they felt comfortable with is now $680,000 and dropping in a way that no longer feels like a temporary dip. Person B keeps the $1 million intact. Same health event, same market conditions. But because the principal was never reduced, the portfolio absorbs the pressure without permanently breaking the structure. They are stressed, but they are not cornered. The difference between those 2 outcomes is not luck. It is whether the $100,000 was still in the account when it was needed most. Now here is the number most people do not think about when they are calculating how much their retirement savings can actually afford to give away. According to Fidelity Investments' retiree health care cost estimate, a 65-year-old couple retiring today can expect to need roughly $345,000 out of pocket just for healthcare costs throughout retirement. That does not include long-term care. That is after Medicare. That is just premiums, co-pays, prescriptions, and the things insurance does not fully cover. For a single person, that figure is around $172,500. So do the math on that $1 million. Pull out $345,000 for healthcare. That leaves $655,000 to generate income, cover housing, food, transportation, and everything else for 25 to 30 years. Under the 4% rule, $655,000 produces about $26,200 a year. That is $2,183 a month before taxes. That is not a gold mine. That is a tight budget with no margin for error. And that $345,000 is not a worst-case scenario. It is Fidelity's baseline estimate for a reasonably healthy couple. It goes up significantly if either person develops a chronic condition, needs home health aides, or requires any level of memory care in their later years. Close to a third of your $1 million is already spoken for. Not by you, not by your family, by the healthcare system. It is sitting in your account right now, but it has a prior claim on it that most retirement conversations never acknowledge. When you understand that, the guilt around saying no starts to dissolve, because you are not protecting a surplus. You are protecting a structure that is already under pressure from costs your family cannot see. The person who lends $100,000 to an adult child today and then runs out of options at 78 does not just hurt themselves. They become the burden they were trying to prevent. Their child, who they helped generously a decade earlier, now faces a different kind of ask, one that is much harder to say no to and much more expensive to absorb. Protecting your retirement is not a selfish act. It is the long-game version of taking care of your family. Have you ever felt that pressure, the quiet expectation from someone you love that your retirement account should be available to them? Drop it in the comments. You do not have to use your real name. Sometimes just saying it out loud is enough. Let's say your adult child comes to you and asks for $20,000. Maybe it is a down payment. Maybe it is startup capital for a business idea they are genuinely excited about. They are not being manipulative. They trust you, and that trust feels like an obligation. This is the moment most retirement plans quietly start to fail. Not because of one $20,000 request, but because of what that $20,000 stops doing. Money pulled from a retirement portfolio in your mid-60s does not just disappear. It loses 20 years of compounding growth behind it. That one withdrawal, depending on your allocation, could represent $60,000 to $80,000 in future portfolio value. That is not a guilt trip. That is arithmetic. So how do you say no without blowing up Sunday dinner? Boundary 1, blame the structure, not yourself. You do not have to be the one saying no. Your retirement plan can say it for you. Something like, we lock that money into a structured retirement plan with our financial advisor. Pulling from it right now triggers serious tax penalties and breaks the income structure we depend on. This is not a deflection. For most retirement accounts, this is simply true. You are not refusing, the architecture is refusing. That is a very different conversation. Boundary 2, offer knowledge instead of capital. You can be genuinely useful without writing a check. I cannot be the bank here, but I can sit down with you and go through your budget, help you figure out what a realistic loan looks like, and think through the options. That is real help. It preserves the relationship and it does not cost you your runway. Boundary 3, the rule of 3. Only 3 people should ever know your actual number: your spouse or partner, your financial advisor or tax professional, and your estate attorney. That is the list. Not your children, not your siblings, not your closest friends. The moment the number circulates beyond those 3, the expectations follow. You are not being secretive. You are being structurally sound. I am not a family therapist. I cannot fix every tension that money creates between people who love each other. But from a retirement math standpoint, I know exactly which financial boundaries keep a 65-year-old from having to go back to work at 72. These 3 are on that list. Setting these boundaries may create some friction today. What it protects is your dignity, your options, and quietly, the long-term respect of the people you are trying to say no to. There is a version of retirement where you spend the last chapter of your working life accumulating enough to feel secure, and then you spend the first chapter of retirement defending it from the people you love most. That is not what the money was for. The $1 million you built is not a monument to your success. It is not a signal to broadcast. It is a quiet infrastructure, one that pays for your health care when things get expensive, covers your housing when you can no longer work, and keeps you from becoming financially dependent on the same children you are trying to protect right now. Financial privacy is not selfishness. It is a shield. The people who understand this tend to move through retirement differently. Less reactive. Less guilty. Less caught between what they want to give and what they can actually afford to give. They have drawn a clear line between generosity and self-destruction, and they hold it not because they stopped loving their family, but because they understood the math well enough to know what is actually at stake. You spent decades building something real. The final act of that work is protecting it quietly, without apology, and without needing everyone at the table to understand why. If this gave you a clearer way to think about protecting what you have built, subscribe to Wiz Investor. We will keep walking through the strategies that matter most in the years when the decisions you make carry the most weight. Thank you for watching, and I will see you in the next one.